This speaker is directly from Clearwater, Florida. He has an office there of maybe 30 people. I was extremely impressed. Last year, they did over 400 commercial loan modifications all across the country. They're very versed and they have MBA accountants, they have real estate professionals on staff. And
You're hired.
Huh?
You're hired.
Yeah, I am. And Jeremy said, I want to be last because the room will be empty when I'm through. So here's Jeremy.
No, actually, I think what I said was I want to go last because I don't want to cave anybody's head in. And the reality is that everybody on the panel up here is saying the exact same thing that I was going to say. When I look at my notes I was taking as George and Del were going through their presentations, they were dead spot on. So I'll just touch a little bit on some of the things that I'd like to elaborate a little bit on. Obviously, we've established that the current economy is put an incredible amount of pressure on commercial real estate. We've all seen the precipitous drop of value. I think off the top of my head, 43% decline in valuation since October of 2007. I anticipate it dropping another 17 to 20% this year. And as George said earlier, I don't think that it's going to stop anytime soon. I think what we're going to find is that this continuation of the credit crunch is going to go further into 12, 13, and 2014. Vacancies last month, has anybody followed this? Increased 40 basis points. It's the largest gain in history. So that's clearly not any good news. 200 points so far this year, and we're just barely halfway through the year.
Vacancies in commercial?
In commercial real estate, correct. We have, and this is a good estimate, about $3.5 trillion worth of loans that are outstanding and that are about to come due in the next 12 to 14 months due to the illiquidity in the credit market. We're not necessarily seeing lenders, because of the debt-to-income ratio and the DSCR, be willing to roll those loans out, leaving them into, even if it's a performing asset, into what's called a technical default or a strategic default or whatever moniker you'd like to put on it. The Congressional Oversight Panel, and that's kind of an oxymoron if there ever was one, says that there is $1.4 trillion in commercial real estate loans that are going to reach the end of their terms in the very near future. The largest losses are scheduled to begin next year. It's going to be anywhere in the range of $200 to $300 billion. So that's government accounting to you, give or take $100 million. On September 15, 2009, this is probably not news to everybody, but the IRS issued some new statements in regards to REMIC, saying that if there is a significant risk of default, loans may be modified. Now, what is a specific risk of default? Is it a tenant who comes up to you and says, you know, we're paying above market, we've been a tenant for a long time, we want fair market value. Enough of this net. We want fair market value right now, or we're vacating the premises. Is that a risk of default? Because if that income leaves the property, guess what happens? There's not enough equity left over to cover the debt service. So in that case, you've got to get on the horn with the master servicer and get it expedited over to the special servicers. Master servicers aren't going to work with you. They just won't. They're not allowed. Especially on a CMBS securitized loan. It has to go to a special servicer who's authorized to make concessions on a loan. The Board of Governors for the Fed issued a policy statement advising financial institutions to extend and restructure loans whenever possible. That's the only guidance that we've seen come out. Now, who gets to decide whether or not a loan should be extended or not? I'll tell you, it's a 22-year-old kid, 23-year-old kid who just got his MBA, and they gave him a name like asset manager at one of the big special servicers. And I swear to you, I believe that during their training course, they're told that it's still 2007 that it's okay, we'll inventory the property and we'll go ahead and sell it later. That's what you deal with when you're dealing with these master servicers. So the trick, without giving away the secret recipe, the trick is to clearly demonstrate, because of the nature of their job, understand that they have a fiduciary responsibility to the bondholders and the tranche holders of the securitized loan. But on the other hand, they have to perform in the best interest of the master servicer. So nowadays, the best move, some would argue, would be, oh, we're just going to move it into foreclosure. It may take a substantial amount of time. Scratch that. It does take a substantial amount of time because they all want to act like the monkey. See no evil, hear no evil, speak no evil, until it becomes a disgusting wart on their face that they have to deal with. So what happens is they move it into foreclosure, and then they take possession of a property that is a barren wasteland. Now, because of their conflict of interest, and understand a special servicer nowadays is dealing with a conflict of interest, because on one hand they have to act in the best interest of the bondholders, and on the other hand they get paid very handsomely, I might add, to move things into foreclosure. The very act of moving something into foreclosure violates the fiduciary responsibility that they have to the bondholders. So what we do is we presented a package to them that clearly demonstrates that they are not acting in the best interest of the bondholders. That if they do exactly what we tell them to do, yes, sure, they're going to take a hit. We're very sorry about that. But the reality is that the reason we're in this situation, and the reason that the credit markets are so tight, and I think you'll all agree, is that because there's so much bad debt. If some of this bad debt was cleared up, it would free up the liquidity in the credit markets. So that's one of the scenarios that we deal with. There's two types of scenarios typically that we deal with. The first one is just an extension on the mortgage. You have a balloon coming due. The second is the real nightmare scenario, which we see 95% of the time. So in those cases, what we need to do is take a look at the financials of the property and make sure that really what I'm looking for is an angle. Can I present this to the special servicer in a method and a manner that compels them to move in the direction that I want? Currently, we have just under, I think at last count, $210 million of assets under control that we're restructuring. Back to the regulatory issues. One side argue that not enough is being done to solve this issue. On the other side, you have the other end of the spectrum is we don't want the government involved. This is a banking issue. Keep the government out. So wherever you lay on regulation of the banking industry, you're always going to have detractors on each side. Wherever it goes is, to be quite frank with you, a mystery to me. The bottom line here, commercial real estate isn't going to emerge from these lows anytime soon. Okay, smart money, real smart money. We were speaking earlier of the coin term strategic defaults. Anybody reading the newspaper recently? $3 billion mortgage strategic default. That's happening every single day. Smart money is looking at this, and when I say smart money, I mean real estate brokers, mortgage brokers, commercial property owners. Smart money is looking at this as an opportunity, because if I were a commercial property owner and I had the ability to restructure debt and take a once $10 million property and be able to either buy the note at $6 million or restructure the terms, extend the mortgage out at a discounted principal balance, wouldn't that make sense as a business decision? And smart money has the ability to come out of this smelling like a rose if they play their cards right. That's all I got.